This is Charting the Markets.
Hello, everybody, and welcome back to Schwab Live Daily. Our next topic is our daily edition of Charting the Markets. My name is Lee Bowl, and I'm a trading services manager with Charles Schwab out here in California. Also joining me today is special guest Jeffrey Abelos, who many of you know from the different presentations he does. He'll be joining me. He is the regional investment strategist for other parts of California as well. Where are you today, Jeffrey?
Hey, well, good morning, Lee. I am in sunny, hot, but very beautiful Phoenix, Arizona.
Okay.
Nice day outside. It's just a little bit warm, so the air conditioning is very, very much appreciated.
Awesome. All right, just a couple of logistical items before we get rolling here. We want to hear from you, so send in your questions in the Q&A functionality underneath the presentation window. Your questions are private, want to be seen by Jeffrey and myself. We'll keep our eye on them to make it as interactive as possible, but we can't always get to all questions due to the number of people on these sessions. We also have our required written disclosures. Everything we'll talk about should be considered as educational and informational in nature only, nothing construed as a personalized trading recommendation. Any expressions of opinion that either of us make could change at any time based on market conditions. We look at a lot of charts, but Schwab does not recommend the use of technical analysis by any means as your sole method of investment research. We evaluate sectors and industries and broad markets with ETFs, but if you're going to trade those, read a prospectus. And finally, we do look at futures contracts. So if you're going to trade futures, do read the risk disclosure statement for futures and options. And with that, as usual, put up the heat map and I'll review the news flow today. And if I miss anything, Jeffrey, just chime in.
You got it, friend.
All right, so let's start overseas. Japanese merchandise trade data for May was not as encouraging as people hoped. They actually show exports fell by negative 28.3%. That's much worse than the expectations were for a drop of 21%. That caused the Nikkei to go down. It was one of, Hong Kong was up today, China was up 0.2%, but Japan ended up down 0.6% on the news. Moving over to the UK, consumer inflation in May increased at its slowest pace in 4 years, leading to speculation that the Bank of England may increase the size of its asset purchases at tomorrow's policy meeting. So basically, yet more stimulus rumored from a central bank. What did that do to the European markets? As you would suspect, they went up. Germany went up 0.5%, the FTSE went up 0.2%, the CAC, that's France, went up 0.9%, and the Euro Stock 600 advanced 0.7%. Also, the CEO of the Abu Dhabi National Oil Company held an unprecedented meeting of 16 of the world's leading energy executives. And he said, quote, "We are seeing encouraging signs of a rebalancing oil market and the beginnings of economic recovery." Optimism was also expressed by the CEO of British Petroleum and Total, symbol TOT. We'll also talk about, when we look at the oil chart, we will look at the EIA data that came out this morning. Domestically, so after our session yesterday, obviously Mr. Powell was talking in front of the Senate, and he said the Fed will continue to be proactive in supporting financial markets. He also, they're still up in the air about this, Jeffrey. I don't know if you've heard anything more. He's talking to the House today, but they are considering capping yields in different maturities if rates go up too much on different parts of the yield curve. They're really the first time they've tried to control the yield curve. If you watched the market yesterday, as soon as he said that, the financials turned negative, which you might suspect. Today, we had housing starts and building permits. People are looking for a little stronger data than we got, given the surge in mortgage applications we've had over the last week or so. But starts were expected to come in at 1.1 million, but fell short. Came in at 974,000. Permits came in at 1.2 million versus the 1.27 million that was expected. And we'll take a look at the housing stocks. They didn't get really hit too bad, especially because Lennar had good earnings a couple days ago. Regarding the virus, which the market seems to be ignoring, China is accelerating containment measures in Beijing. It's lifting its emergency response from level 1 to level 2 and is now requiring a negative test before you can leave the city. Um, Also, all schools have now been ordered to close, and the restrictions were imposed on visits to all residential communities, and they also canceled 1,200 flights in and out of the capital city there. 31 new cases reported on Wednesday. They've had now 137. Also, cases linked to that cluster have already been reported in 2 provinces in China's northern region. So it's already spread out of Beijing a little bit, apparently, on that. Domestically on the virus, the city of Miami just said a little while ago that it is now pausing its reopening, as Florida just reported 2,783 cases, which is a daily record. Now, some of that, of course, is due to increased testing, but it is a pretty big jolt up. Uh, Texas also reported a new high for hospitalizations. They were up 11%. Now, none of this is encouraging, all this virus stuff, but of course, the market doesn't seem to care. It's looking ahead to 2021. And there's 2 ways you can look at like what Miami's doing. You know, it could be construed as good in terms of a precautionary step to stop future outbreaks, or it could be considered, uh-oh, the thing is starting a second wave. It's hard to tell, but the markets are kind of just saying, we don't care, we're just buying on the Fed's aggressive policy support. Also in virus news, the CEO of Moderna told CNBC that there is a high probability of success regarding its vaccine. All right, let's take a look at our commodities generally. I'm just seeing a range here, Jeffrey. I don't know about you. You're kind of, there's really no trade here one way or the other. You're right in the middle of the range. Risk to reward is kind of even. I
Yeah.
think you got to trade it as a range, you know, buy on a little bit of weakness, sell on strength, but your thoughts?
Well, I agree. This is when you're range bound, you know, as somebody that likes to trade options, this is what people look for when they're doing the selling of a call spread or selling of a put spread. As it starts to go down, you sell that put spread. As it starts to go up, you sell that call spread. And so that way you're able to make money on both sides of the trade. But Lee, I think you're exactly right. From the point that we saw back in, let's say, mid to late February, then early March, there is now forming your support line, which was old resistance. And then you hit the nail right on the head with the about April 10th to 12th time period. And then again on the May 16th, 17th time period. So yeah, just nice and range bound. I don't hear a whole lot of worry coming out about inflation, which is generally, you know, gold is considered that hedge against inflation. But is there anything that you're looking for in the news or that you're listening for to see a breakout of this range?
Uh, well, the only thing I would say is it's not quite acting. Um, you know, it didn't really go up when we had that big down day of 1,800 points, which told me a little something that maybe it's to a certain extent losing its safe haven bid just a little. Because so this is today, yesterday, Monday, there's Thursday when the market, you know, went down that huge amount and it didn't really budge. So a little bit of a tell there. If you're trading a range, maybe you use, you know, you don't use moving averages as much as maybe oscillators. Let's just see what the stochastic oscillator might be put up there to give you entries if you want to trade it on a range. So what we're going to do here is go to studies, view all studies, and we're going to do the stochastic, which for this purpose I think is a little bit better than the RSI, and we will do the slow stochastics.
And why would you think the stochastic is going to be a little bit better than the RSI, just for our viewers?
Yeah, the RSI, let's put up the RSI and we can see. Open that up. So I'm going to take off that. I'm going to take off that. The problem with the RSI is that you're not getting down to the boundary levels, right? You're not getting down to 30 to give a clear signal. You're not getting up to 70. So the only way you could make that work is to
Tighten them up.
tighten up and do the much shorter time frame. But you can see the stochastic has given you pretty good signals. It has got down, like it gave you a buy right in here as fast D cross slow D right at 25. And, it's been a little bit better. And you can see it gave you a pretty good sell signal up here. We did get totally overbought. And right here was the signal to sell, where the RSI, you never know exactly unless you're really shorten the time frame, clear levels. So I like RSI for divergences, but
Okay.
for trading ranges, I tend to like the stochastics more. And you can see
Love it.
why, I think. All
Oh,
right,
yeah.
let's take a look at oil. So let me put on a couple of lines here. So I think there's your line in the sand in the short term is $35, at least on the July contract. The EIA data came out today. I'm surprised we weren't down a little bit more. We are down like, almost 0.75%, but the crude inventories increased by 1.2 million, and the expectations were for actually a draw of 152,000. So a little bit bearish on that as well. Also, we are still above, or 15% above the 5-year average for oil and storage, and gasoline is still 10% above the 5-year average. But I think oil is trading on obviously economic recovery maybe later on, but certainly you can set your risk pretty well here.
Yeah. Yeah, you got that 35 line pretty well drawn. And I know I was reading an article yesterday about BP saying they're doing some layoffs to make sure that they can make the company last at $35 a barrel.
Exactly. That's a really good point. Yeah. So anyway, maybe you buy pullbacks to 35 with the stop right under, and look for the breakout of the previous high. And then if that happens, maybe you start trailing a stop on the 10-day moving average, which has acted pretty well on it. Let's take a look at the doctor.
Copper. All right.
So we broke out of the channel there, using it as support right now. At least you can say that overall, it is supporting the equity market. There's no huge divergence. So the last couple of days where the market's been going up, it hasn't been going up. We'll just have to see if, but really all it is a pullback to support at the moment. But we'll have to keep our eye on that. But generally, at least, from the March bottom, it's been going the same way as the equity market, which is a little bit positive confirmation.
Yeah. I like that breakout too, especially on something like copper that you're trying to look as a leading indicator for new development. So hopefully that can sustain. Are you more of the opinion that you're looking at copper as something to be the leading indicator for a market cycle, or would you say something like the transports, which has historically been one of the leading indicators, get your attention?
Yeah, well, what I've noticed is copper had been a leading indicator. It's turned more into a coincident indicator. What we don't want to see though is a big divergence. Let's put up the SPY as an overlay. So, I mean, to a certain extent, you can see it has followed along. But as I said, the only little thing is bothering me a little bit is you've got, let me get my segment line up here. You've had this rally in the market, but copper is kind of going the other way. We'll have to see if that lasts. So we want to keep our eye on that, because you can see generally they went exactly in the same way. Now for the last week, they really haven't. And Alan in Ohio is saying, isn't a rising wedge usually bearish? Yeah, but the signal is only when you take out the lower trend line though. So anyway, I'm just keeping my eye on this. This is the last few days, it's different behavior than we have had. Because you can see every time we go up in the market, it goes up, right?
Yeah.
And now we've gone up and it's gone down. So anyway, so
No
I am
hesitation.
beginning to watch that now a little bit more carefully,
Okay.
perhaps as a tell. Let's take a look at interest rates. Take a look at the 10-year. Failed breakout, I guess you'd have to say there, Jeff, right?
Yeah, absolutely. And it it gave you what, three, almost four closing periods. That for me personally, that's what I look for as confirmation. So in that example, that would have been a trade at about the $8 level. That would have been a trade I might have entered and then
Yeah,
subsequently exited pretty quickly.
yeah. I mean, to your point, it did look like a good breakout, and then it failed.
Yeah.
But you would have been well within your right to trade that breakout because it did last above that resistance.
Yeah,
But
just
now we're
another
back in
great
here.
example too that we're not always going to get it right, and that it's important that you keep those stop orders or your limiting losses, whatever you want to refer to them or however you use them. But make sure you have that point where you say, you know what, I was incorrect about this movement, and now I'm going to limit my losses.
Yeah, I mean, very sage advice for sure. Let's take a look at our bond signal on the TLT. So we got a sell signal in here that got us out of our buy down here. It's kind of choppy though. Um, and they're right next to each other. So maybe there's no trade right here, right at the second. I mean, if you were going to do it as a totally trend following, um, then you would be short the TLT. But since it's kind of choppy and they're right next to each other and they could cross either way, I would say, to act on that, you'd want to break these lows in here, somewhere in here, 157. But we'll see. Uh, not having a position right now might be something. However, if you take out, some lows, the faster moving average will pull away and it'll confirm the signal more. But if you're a purist, you would have sold right there. All right, let's put up the SPY. And you had talked to me earlier in our pre-show prep of a very interesting study that you had done. So do you want to walk me through it?
Yeah, absolutely. So one of the things that I'm a big fan of to our viewers out there is the Fibonacci sequence, and that's something that you see occurring in nature. If you look at seashells, if you look at sunflower plants, if you look at the way that the tulips on different flowers will grow, that is or not tulips, excuse me, the the petals on different flowers grow. It's a sequence that you see all over the place, and they even call it the golden ratio, and artists use it all the time. But here at Schwab on Street Smart Edge, we do have access to three different Fibonacci tools, and the one I was looking at is the one that Lee's pointing out right there, that Fibonacci fan. And the way I used it was I took that low that we had on March 23rd, and then I do a left click and I drag, and I brought it up to about April 29th's high, which is about 290 or so. Yeah, and then you kind of move it around a little bit and see if you can get it in a couple places. But that essentially is what's been captivating my attention. You see that after we dropped past that April 29th low, we found ourselves at that 23% line. And then when we broke below that, we found ourselves walking nicely, actually, for a little while there along that 38.2% line. And now that we've broken below the 38.2% line, that 50% line is what's captivating my attention. So I've had this on my chart since about April, we'll call it late April, when I saw it start to pull back off that 29th high. And this has been a very, very big help. So even though you're seeing it starting to you still have an upward momentum, which is great. But if you're an options trader like myself, you can still find those ranges and those support lines that can help to develop a potential spread or options trading strategy. So that's something that's really been captivating my attention over the last couple of months, Lee. And it's done a pretty good job of defining some support levels for me when we've broken below the previous ones.
Yeah, that's really good. I generally use the regular retracements, but this is very interesting how it's been kind of reacting to them. Look at that bounce right off the 50%.
Yeah.
Yeah, so that's extremely interesting. Let's go here and put up the SPY again. I do have some interesting data.
All right.
Um, that we want to talk about here. So a few things. As we know, we had that huge gap up yesterday, right?
Yeah.
And it was over 2%. And so obviously it piques your interest. You don't have 2% gaps up, that often. And has it meant anything? Well, if you're keeping track, since 1993, there have been 56 2% gaps up. And what did it do going forward? Well, here you go. The next day, which is today, right?
Mm-hmm.
You're only up 40% of the time. So you walk past, I mean, it's a little bit of a weakness after that the next day. We'll see if that happens in the close. A week later, it's a coin toss what the market does. But it gets better a month and 3 weeks, and a month and 3 months out. So it is my view has been that we're kind of in a choppiness, maybe for the next month, and this kind of I said probably supports that a little bit. The next thing I want to talk about is sentiment. So as you know, both Liz Ann and I follow the smart money, dumb money. And so what's very odd is that we have gone from the dumb money from real pessimism to pretty high optimism. It's 76 now, and it was as low as 20. The interesting thing is, on average, usually as the market goes up, that process takes about 84 days. This time it only took 51 days. And so, of course, it is faster than usual, and it was a pretty big, quick spread. So what we did was we looked at, all right, when dumb money cycles from below 20 to above 75, for the last 20 years, did it mean anything? And again, for the next couple weeks, it was very choppy. A month to 2 months later, the market was up about 60% of the time. So again, it's just telling me there might be a little choppiness here for the next couple of weeks. Now, I will say that after that cycle, we had that big drop of the 6%. So there is some thought that was that the pullback that it was suggesting, and now is it over? And
Yeah.
I don't really know how to view that. But
Well, it's similar to how it was, if we look back in late April, early May, when people were saying, well, was our March 23rd low, was that the low? It's a little too early to tell. You still need more things to play out. And here you're only, 4 days after that happened. So, it would almost be like trying to look into a crystal ball to get a definitive response on if that's what you were looking for.
yeah, and I found something also kind of interesting. I know you do our seasonality webcast a lot.
Yeah, love it.
And I just, we're about 100 days from the presidential election, right? So I think you might want to watch the polls or the betting sites for the odds, because this is very interesting. Okay.
I can't wait. Tell me all about it. You got me excited for this one, buddy.
I know. All right. So here it is. So looking at past elections, the summer and fall had a strong tendency to be positive if the White House remained in Republican hands. But if a Republican ended up losing to a Democrat, the summer was usually a rocky affair. So if Biden starts pulling away in the polls, at least history says that that wouldn't be as good for the market as if the president's poll numbers kind of went up. So It's very interesting. So I'll just give you some numbers here. So when the Republican holds on to office, starting 100 days out, which is where you are now, a month later the market was up 67% of the time. 2 months, 78% of the time. 3 months, 78% of the time. Compare that to when the Republican loses to a Democrat. And this is from 1900 to 2020. 1 week later, so we said for the Republican keeping it, 1 week later was up 67% of the time. If a Democrat takes it, only up 20% of the time. 20% of the time only up in 2 weeks, and 20% of the time up in 1 month. So just keep your eyes on the polls. I thought that was pretty interesting too.
Yeah.
All right. Let us look at the cues. So it's been one of the strongest groups. And let's compare the market weighted to the equal weighted here. So
I love this because it takes out those big five companies from such a strong position. I know that let me make sure if I can get this right, but this was on June 7th that I had gotten this information, but Amazon, AMD, Netflix, and Salesforce were all trading more than 50 times forward earnings,
Wow.
which I just thought was incredible. So it's nice to be able to see something like you're about to show us here, Lee, where you can say, all right, let's take out that weighting of these giant companies that may be holding things afloat and see how we're doing on an equal basis.
Yeah, and you can see that generally speaking, except for this little pullback in here, if you draw in here, you can see generally speaking, the QQQ is, you can see it is an upslope, basically.
Mm-hmm.
So it is showing that those big companies are certainly leading the charge.
Yeah. And real quick, we've got so some people are mentioning about the polls and so forth. If you do want to get the actual statistics, we are going to have that cycles and seasonalities presentation. It's called Cycles and Seasonalities in the Stock Market, and it'll be on June 21st, and that's at 12 p.m. Eastern time. And also, I've got to mention, Lee, I want to make sure I get this in here. I was talking to our friend, Mr. Lou Mercer, and he wanted me to make sure to wish you a happy birthday month. Lee, happy birthday month to you, big guy.
No, thank you. Thank you.
Yeah.
They say you're not getting older, you're getting better. I've just found you get older. All right, so that was kind of interesting. And now I want to look, so, and we've been having this discussion here on Charting the Markets. I'd like your view on this, Jeffrey.
Yeah.
It's almost that these big mega cap tech stocks are a defensive play now, where the institutions, if they want exposure, they want deep liquid names, they just kind of rent them for a while. And then David in Oregon had said earlier, I don't know if it was on this webcast or before, that maybe they're turning more into like consumer staples, right? Because you need your phone, you need this, you need that. So, maybe the fact that the big technology stocks are leading is not the same impetus for the market that it might have been.
Yeah, I would agree with that. I mean, if you look at Amazon alone, their retail store makes up 50% of all new book sales. And that, that has nothing to do with technology. That's a physical paperback or hardback book. If you want to talk about e-sales, 3/4 of e-sales in the United States come from Amazon. So I think that's a very astute observation in that some of these companies have turned a little bit into the staple environment because you are now going to Amazon for just about everything you need. You're going to Microsoft for all things connecting in the network of business. So I wonder if that'll continue in the way it has been, because now that it's so entrenched and ingrained in what we do every day in our lives, it does make it harder to say that this is now pulling away because it's something completely innovative. which it's not. We're not seeing a bunch of drone deliveries coming to our homes. It's still the drivers and the vans that we see on a regular basis. So that's a very interesting observation. You said that one was from David in Oregon?
Yeah.
Yeah,
Mhm.
yeah, very interesting call out, David.
Okay, let us look at the Russell. I got some stats on the Russell here too.
Okay.
All right, we were up 2% 3 days in a row. That doesn't happen that often. Okay.
Okay.
As a matter of fact, there's only been, other than the one we just saw, 3 times in history since 1979 that has happened. Um, so what does it mean? That's always the question, right? Again, the data shows that you're going to be choppy to slightly lower over the next few weeks to a month. Now it gets much more positive 3 months out. Um, so again, that's just adding to my feeling that maybe we're going to chop around here.
Mhm.
But anyway, so it did give back quite a bit, especially when it was near highs. So it's not quite as dour as that because we aren't really near the highs. Um, but anyway, it's just a little bit of again, a little bit of a warning for what it's worth. These statistics, are things different now? I don't know, but we're just seeing an awful lot of confluence suggesting we might be kind of choppy here for the next couple weeks.
Yeah.
Anyway.
Anything that you're looking for as a catalyst to that? I know we don't have earnings this time of year, but are there announcements or something about the summertime that you're looking for to be an instigator of that?
Um, well, I think the market, I think, is trading on central bank stimulus. So, maybe the next Fed meeting, if they say
Okay.
something that people aren't expecting, could be a catalyst one way or the other. Um, but they pretty much come out and said that they're going to do what's necessary. So I think, that's the reason the market is really up. So I think that would be the thing to watch for if they change that. And we got a question on, is choppiness typical of the summer period in June and July anyway? Yeah, let's take a look at the seasonality on the S&P. We can do that. I know that Jeffrey will cover this more in that. And when was that again? We have a question on when your seasonality is going to be.
It's, oh, sorry. Yeah, we accidentally said June 21st. It's July 21st. I apologize. July 21st, and it's at 12 p.m. Eastern time.
Okay, perfect. All right, so let's just take a look at the SPY, and we will go back 20 years. So you can see this kind of speaks to what you talk about, that it is relatively a weaker, these 2 months are relatively weaker, but they still have been positive,
Hmm.
but relatively weaker. You can see, even though we're up 55% of the time in June, the actual rate of return is average, it's been negative, negative 0.5%. And then you can see in August, again, it's not one of the weakest as far as number of times up, but you can see negative 0.3, and in September, negative 0.5. So you can see we do have seasonal weakness coming in, which leads me to believe also, again, a little choppiness going forward.
Yeah. Now, yeah, I mean, this is a way, way, way ahead of the time, but with most of the market crashes happening in the September, October period, that also correlating with the cooling down and winter weather, which, as I understand, that's where the coronavirus thrives more. Is there anything that's happening right now that is giving you pause or concern over perhaps a bit of a bubble forming and maybe even a popping of that happening in September, October? Or do you think as long as the central banks continue to flood money into the market, we should be okay?
Yeah, I think the latter. But, what wouldn't be good is they say, okay, we're doing QE infinity here, but we're not going to do it past X.
Yeah.
That would probably be pretty negative for the market, I think. Anyway, all right, let's look at the sector and industry action. So this one has been on a tear. Nice breakout on this one. What is this? This is dry shipping rates. Again, speaking to a little bit of the reopening. A reopening narrative. Let's take a look at the Baltic Dry Index, which some people follow also kind of in the same vein. And let's go take a look at that. So I got to get my list back here. And I know Jeff Kleintop looks at the Baltic Dry Index too. See if that's going the same way. Yeah, see, so it is showing improvement, right? This is, so you have the shipping of dry products is really picking up, which is a sign of reopening.
Mm-hmm.
So this is, to a certain extent, supporting the reopening narrative. And you can see it in that ETF too. What else is running? Let's see.
You can also find more information on this too to our viewers. Jeffrey Kleintop comes out with his 90-second update every Monday, but he also comes out with articles, and one of the things he's looking at is a bit of a heat map of reopening. So if you ever get the opportunity, that's in our market insights section on schwab.com. But go ahead, Lee. Sorry to cut you off there.
Yeah, no, excellent. So Chinese internet stocks are moving again. Let's take a look at those. Of course, you got to have the right symbol, Jeffrey. I found that out.
I do that all the time. All right, I flip them around, and I'm like, that's not quite the company I was interested in looking at.
Yeah, so you might want to take a look at some of these companies just broke out of a flag. We can do the measured move on this one.
Sounds good. Big fan of the measured move.
So there's the flag. Flag pull is what, 50.77 to 50.83. Was that eight?
About 8 points.
8 points from 58, be 64 maybe.
Yep.
Again, simply an approximation, but anyway, it's a good looking chart for sure. Now, we don't recommend you trade these ETFs that we show you. We're just doing it for, maybe you look in what's in there. And Jeffrey, you're going to talk about how to find what's in there.
Yep. It's coming up next. Yeah.
Coming up next in the webcast. I should also announce that speaking of Jeffrey Kleintop, that he and I are going to be doing a weekly Monday show starting in July 13th.
Oh, what's that going to be about? That sounds exciting.
It's called Jeff's World, and he's going to go over all his research from the previous week. So you will have a chance every week to hear what he's thinking. So.
Oh, perfect. I'll be making that in the calendar.
All right, let's see. Let's see what else is moving. Let's take a look at energy with been coming back a little bit. So we broke support for a few days.
Yeah.
I guess if you're an optimist, you'd still say higher lows. So, and let's put up any moving average to do your risk. So the 20-day looks kind of interesting.
Mm-hmm. I like that 40 level though. And this is similar to what we were talking about earlier, where you had a bit of a false breakout. Another great example of why it's important to limit your losses and know where your exit points are if you start going the wrong direction before you get into the trade. But here, how you've got that 20-day simple moving average up there, that also seems to coincide quite nicely with the 40 price level. And one of the things that I have people ask me about, and I'm sure you're the same, Lee, they say, well, how far below your support do you put it? For that, I generally look at something referred to as the average true range, which Lee has down here as one of our studies. And that lets you know on any given day how high up or down this particular company can go. So if you have something like an average true range of, okay, so we're looking at, we'll say $2, you're generally going to have your stop or your exit point at least $2 below wherever you define that support line as. So if I were looking at 40 as my support, I would want to make sure I'm at least below $38 before I start sticking in my stop prices.
Absolutely. Absolutely. All right. That's kind of interesting, a little bit. It's down a little bit today based on that EIA data.
Mhm.
Let's see what else is moving. The gold miners, huh? Even though gold is range bound, let's take a look at, we'll do the smaller cap gold miners. Nah, I mean, they're up a little bit today, 2%, but they're still range bound.
Yeah.
You'd have to say that.
Yep. Good
I guess
points.
if you're bearish, you would say, well, you've had 4 days now where you couldn't get back above the 20-day moving average, which had acted as support, is now acting as resistance. But I think, so there's two ways you could potentially trade this. You could just, put a stop above the 20 by a certain amount of the average true range Jeffrey was talking about, or just wait for the breakdown if you want to go short. Similarly, since it's a range, you could look at the stochastics and see if you're giving a signal to buy the bounce at the bottom again with the stop right underneath. So how you could trade that. All right, let's see what else is going on. Yeah,
Global X video games. What is that all about?
yeah, that's a video game ETF. So we can take a look at that one.
Okay. Hero, Hero.
Yep. And we can show you what's in it.
Great ticker symbol.
It's
Wow.
also a great chart.
My goodness.
Yeah,
I guess the pandemic and quarantine has helped out the video game
exactly,
economy just a
exactly.
little bit. Goodness.
So sometimes you got to go to schwab.com. We can just show you how to do that. I mean, Jeffrey's going to go over a lot more detail, but
Yeah, figuring out, okay, well, what exactly is inside
yeah,
of Hero, right? It's probably a good
that's right.
idea to know what you are trading.
Yeah.
There you go.
Activision Blizzards, NetEase.
Yeah.
But there's also some other ones, ones that NVIDIA is in there because, their chips support a lot of that gaming. So it's a pretty kind of diversified group,
Wow.
but it's a wonderful chart.
It is.
Let's see what else is moving. Again, what you can do with this is just, it tells you maybe where to look. If you're looking for a trending one way or the other. Let's look at, we had a couple of biotechs in here that are still up. Let's just take a look at the major ones. We've been stopping these.
Okay.
So at this stage, watch for the breakout. We are correcting this big move by time, which is a stronger type of correction than by price. So watch for the breakout on this one.
And has that been going up and down? I don't know if you would have noticed this. You kind of have to do a little bit of a study on it. But as different companies come out and say they may have a vaccine, they may have some treatment, have you noticed if this has been spiking on those days or dropping on others? Or
yeah, no, to your point, yeah, when you have some of these results, these
Mhm.
tend to move. Everybody's thinking, well, the biotechs will be the one that helps us get through this virus situation. So, to your point, well made. That is what I've noticed. Let's take a look at the bigger biotechs too. Again, they're kind of range bound. They broke the triangle, but now they've gone into just a trading range here. So again, I think you want to look for the breakout. Either way, but certainly, yep.
Yeah.
All right. What else is moving? We got one more minute to take a look at something else moving. Yes, cloud computing has been on a tear. That's a nice breakout from a horizontal consolidation. Yesterday, was for the breakout, but today looks much better. again, a measured move here is about $1, 1940 to 2050 on that. Trail of stop on the 20-day on that one.
Yeah, that 20-day looks to be a pretty good support line for, let's say if you're in the trade for maybe a week to 2 weeks or longer. It seems to have held itself up nicely over these last couple months.
Absolutely. Oh, and with that, Jeffrey, our time is up. It goes fast, doesn't it?
It does, man. And I always learn so much. I take notes the entire time and always appreciate getting your insights on what's happening in the market, Lee.
And again, Jeff will be back right after this to go. We looked at a lot of ETFs. He's going to tell you a lot more about ETFs and ETF strategic uses in today's market. So stay tuned for Jeff. Thanks, everybody.
At any point in time, stock prices are trending upward, trending downward, or trading in a range. And really, that's it. As a trader, it may be useful to know which of these scenarios you're seeing. Technical analysis uses charts to track price and volume ranges over various time frames in an effort to gauge which way the stock may move. Identifying these trends and price action can help you decide when to enter a new trade or exit an existing position. For the technician, price is king. Technical analysis can help you take the emotion out of trading because it assumes that all of the news, the earnings potential, and consumer sentiment are already baked into the existing price. This means that you trade based on what you see happening, not what you believe should be happening. Because psychological factors can also drive markets and are often predictable, technical analysis uses charts to offer a picture of how markets act when a stock reaches certain price levels. By watching for changes in price action and trading volume, you can gain insight into what other traders are doing, and that can help you make better decisions with your trades. So let's look at an example. If a stock has a history of retreating to $50 per share and moving higher from there, you could enter your trade near the supporting price of $50 and look to sell once it moves higher. Keep in mind, you shouldn't rely on past performance to assure success no matter which indicator you're following. In this example, you would want to set your stop order just below this $50 level to help limit losses in case the stock were to reverse and fall through our support level. Falling through this $50 level of support would be a clear departure from what the stock had been doing. It can indicate a shift in sentiment, meaning many traders might have lost interest in this stock. And once that happens, the price could continue lower to its next level of support, making your stop order very important. And remember that there's no guarantee that your stop order will be filled at or even.
Here we are looking at two indices, the Dow Jones Healthcare Index, which is the green line, and the overall market as represented by the S&P 500, which is the orange line. Notice that from June till October, both indices were trending higher. We now look at the price relative line, which is the purple line in the lower pane, and we notice that it is sloped up. This means that healthcare is outperforming the overall market. If the symbol you are interested in is outperforming, you will always see that line sloped up. Now let's move over to December. As we see coming off the bottom in December, again, both indices were trending higher, but now we look at the price relative line and it is actually sloped down. This means that healthcare is now lagging the overall market. Remember, if the symbol you are interested in is underperforming the comparison stock sector or index, the price relative line will slope down. Let's move on to another example in the same time frame. Here we are comparing the semiconductors, the pink line, to the overall market, again, which is the orange line. Notice from November till the end of the year, while both indices were falling, we actually see with the price relative line that the semiconductors were outperforming. Then when the market turned around, the price relative line is telling us that the semiconductors were still outperforming and leading the overall market. You'll often see this when in a falling market, the stocks that do best when the market turns around are also the ones that can lead. There are numerous ways to use price relative to generate trading ideas. One way is to compare a sector to the overall market. If the price relative line starts to slope up, it means that money is beginning to rotate into that sector, potentially signaling the beginning of an uptrend. You might choose to buy a sector ETF to take advantage of this move. You could also compare a stock to its sector. This allows you to evaluate whether the stock you are considering is a leader or a laggard. It almost goes without saying that momentum traders prefer leaders. Another use is to compare one broad area of the market to another, such as comparing the price action of the small cap Russell 2000 to the large cap S&P 500. This approach provides all sorts of useful information. For example, if the small cap stocks, which tend to have more of their revenues based domestically, start to outperform the large cap stocks, it could be an indication that the market is worrying about international trade issues, which generally have an outsized effect on the large cap multinationals. Finally, you can combine all these techniques to drill down as much as possible. For example, by examining the various price relative studies, you might find that the large cap stocks are outperforming the small caps and that healthcare is also starting to outperform. You could then build a screen to find a large cap healthcare stock that is outperforming the sector. To learn more about technical indicators and how to use them, check out all the other videos in this series and subscribe to our YouTube channel.
Hello, and welcome to the Quick Start video for the options chain available on Schwab's StreetSmart Edge platform. Let's load the options chain. It can be found in the All-in-One Trade tool as well as SymbolHub. For now, let's load the All-in-One Trade tool and click on Options Chain. In the main lower panel, the chain loads with basic information about each option in the chain, like call or put, the symbol, last trade, the change, bid-ask, the midpoint, volume, and open interest. You can add Greeks, probability, or other quote data in the Manage columns and Settings page. It can be accessed through the Actions dropdown or through right-clicking in the chain and selecting columns and settings. For simple calls and puts, click the arrow at the beginning of each row to display the available contracts for a particular expiration date. For more details about each option, click the arrow next to the contract to display the contract specifications along with other data. When you've selected a multi-leg strategy to trade, click the arrow at the beginning of each row to display the legs in each set. The Option Chain Filters row allows you to determine which contracts or pairings are available for you to view and choose from when setting up an options trade. The filters include Strategy Selector, expiration filters, number of contracts or pairings to show, and when applicable, width. These filters help to narrow down the chain to find the contract or pairing that meets your criteria. To remove adjusted options out of your option chain's display, you'll need to uncheck it in the option chain setting. You can filter weekly and quarterly options here as well. Trade directly from the option chains. Be sure you're in the Strategy Selector tab. Once there, all you have to do is click on your strategy of choice. The trade ticket updates to your strategy, and the contracts or eligible pairings will display in the option chains below. Click on the contract or pairing you want, and it is loaded in the trade ticket above. This sets up a limit order set to the midpoint price for that strategy. However, feel free to change that price to whatever you would like. In the Action field, choose whether to create a buy to open, buy to close, sell to open, or sell to close order. Max gain, break even, max loss, and estimated cost calculations will be displayed depending on your action. Lastly, we have the Views selector, which includes Theoretical, which is a view of calls and puts that allows you to select a Greek model and make changes to the different parameters that affect option pricing as calculated in that model in order to see how those changes would affect the prices and Greeks in that chain. And Covered Call, which shows calculations for covered call or covered put transactions. The Covered Call calculator gives traders an idea of how a buy right might work for or against them at expiration based on what they paid for it and where the stock price was at expiration. These are both estimates based on a mathematical model, but it can be used as a baseline for planning an options trade. This concludes the Quick Start Guide for the options chain on Schwab's Street Smart Edge. Please check out the Learning Center and the online help menu, both of which are located under the help menu. Additionally, you can visit the calendar on schwab.com/live for a schedule of upcoming live platform videos. Thank you for choosing Charles Schwab, and have a great day.
You know that tech stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Schwab saved you how much?
It's time to trade up to Schwab, where you get price improvement on 96% of orders. Schwab, the better place for traders.
Stop and stop limit orders are both tools traders use to manage risk, but they're not the same. Let's look at how they work and explore why you would use each of them. A sell stop order is set at a specific price below the last trade price. If the stock falls to or below this price,
Earnings per share, or EPS, is one of the most widely used ways to gauge company profitability. To calculate, divide the company's profits by the number of outstanding shares. EPS matters because strong earnings tend to drive the price per share up, and that's good for investors. Earnings also generate money the company can reinvest in growth. But EPS has limitations. If a company uses earnings to buy back shares of its own stock, there are fewer outstanding shares in the equation. That drives the EPS up without any actual increase in earnings. EPS also doesn't consider outstanding debt, or that two companies might have the same EPS, but one company used less capital to generate the same profits, indicating it might operate more efficiently. So while EPS is a fundamental factor in assessing stock value, it's most useful when considered along with other metrics.
You know that tech stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Schwab saved you how much?
It's time to trade up to Schwab, where you get price improvement on 96% of orders and commission-free online trades.
I'll take care of this.
Are you getting complete price transparency? Expect more from your firm. Schwab, the better place for traders.
You know that tech stock we talked about? I picked up 500 shares.
You get in at a good price?
Oh, yeah.
Schwab saved you how much?
It's time to trade up to Schwab, where you get price improvement on 96% of orders. Schwab, the better place for traders.
Live from Schwab Studios, this is Schwab Live Daily.
Welcome back to Schwab Live Daily, all my friends. This is Jeffrey Abelos. I have the pleasure of being your host during this next segment. We're going to be talking about ETFs, some strategic uses in today's market. And I am a regional investment strategist for Charles Schwab. My background, as some of you already know, is I've been with the firm for a little over 10 years and have loved every moment because I get to do segments like the one we're going to be talking about today. But of course, before we do, a couple things I want to make sure we get out of the way. First of all, because we're talking about ETFs does not mean I'm saying now let's all go find a way to invest in ETFs. Absolutely not. This is strictly for education and illustrative purposes only. Something else to keep in mind, we may actually talk about options, and you can do options on ETFs, but before you start trading options, make sure you read that Characteristics and Risks of Standardized Options. That is an important document. Also, we might toe dip into the Schwab Intelligent Portfolio. Just know that there are some more considerations you need to take in mind before entering into that product, okay? So be wary of that. It's made available through Charles Schwab and Charles Schwab and Company, which is a dual registered investment advisor and broker-dealer. All right, so with that, what are we gonna go over? Well, we're gonna talk, first of all, what is an ETF? Probably good to get that out of the way. Then we're going to go into how to identify and trade ETFs. And then lastly, I'm going to provide you some resources here at Schwab that we have available to us. Quick question for everybody before we go forward. Is it going to be a multi-choice? I want to hear what you think. So what I want to know is, when was the first ETF, when was the first exchange traded fund created? Was it A, 1950, B, 1975, C, 1985, or D, 1993? A, 1950, B, 1975, C, 1985, or D, 1993. Send those into the questions and comments sections now. We will take a look at those in just a moment. But first, well, what is an ETF? As you're sending that in, I want you to know that an ETF, it's like a mutual fund, but it's also like a stock. Here's why. They're like a mutual fund because they are a basket of securities, okay? They're constructed to track, most of them anyway. Most of them are considered passive, which means they're not trying to beat a benchmark. They're made to track the benchmark. So what are they going to do? Well, they're just going to buy the same basket of securities that's in the benchmark. Pretty straightforward, right? Because they're passive, and again, this is most of them. I would say let's call it 95, 96% of all ETFs are passive, meaning they just want to match the benchmark. Because they're not trying to actively beat the benchmark, they generally have lower fees. And because of that, they tend towards lower turnover. Mutual funds, on the other hand, are generally considered actively managed, meaning they're having somebody, their mutual fund manager, try to beat the benchmark. Okay, so they're trying to surpass whatever benchmark they're being judged against. As a result, they may have to do some more trading in that mutual fund, which is why they tend towards the higher turnover in mutual funds. But the cool thing about ETFs is they trade like a stock. You could see them priced throughout the entire day, which is wonderful in my opinion. I'm a big fan of transparency. So because of that, you can flexibly get into and out of ETFs at any moment in any given day, as long as the markets are trading. Also, they're frequently optionable. Not every ETF has options on it, just like not every stock has options on it. But most of them that trade, let's say, in excess of 100,000 shares per day on average, is going to have some sort of optionability to them. Okay, so keep that in mind. All right, now let's get back into our question before I show you the next slide. When was the first ETF created? Was it A, 1950, B, 1975, C, 1985, or D, 1993? Let's see some answers. We've got C, 1985. I've got 1993. I've got 1950. Let's take a look. Drum roll, please. And there it is. 1993 was when they officially gave the first ETF. But. Here's the best part, and this is what I love about this stuff. That wasn't actually when they created the first ETF. That's when we say they created the first ETF. But the first attempt was index participation shares for S&P 500. That was in 1989. Now, what happened? A federal court in Chicago They ruled the fund worked like futures contracts, so they would need to trade on a futures exchange. There was even a second attempt, my friends. This was on the Toronto 35 Index Participation Units, the TIPS 35. TIP 35, and that was in 1990. That one also didn't work out. And then finally, January 23rd of 1993, State Street Global Investors releases the S&P 500 Trust ETF. SPDR, today we refer to it as the SPDR. It is one of the most popular ETFs in the entire world, and its ticker symbol, if you want to take a look at it, is SPY. How about that? Also, at that same time, January 23rd, 1993, the #1 song was Whitney Houston's I Will Always Love You. Remember The Bodyguard with Kevin Costner? Great movie. Also, January 23rd, I did some research. Other notable times on January 23rd. In 1957, Wham-O produces the very first Frisbee. First Frisbee made by Wham-O, January 23rd, 1957. At the time when ETFs came out, I just want to give some context. Average income was $31,230. Today, it's $61,000. Back on January 23rd of 1993, the average house cost $113,000. Today, it is over $200,000. And back then, a gallon of gas was $1.16. Today, it's a little over $2. But normally, you're talking about $2.60, $2.70. But because people haven't been driving as much recently, let's pull that back down a little bit. Something else to notice along this chart, you can kind of see the exponential growth of ETFs. They just continue to get more and more popular. The Barclays Bank entered in ETFs in 1996, and then Vanguard actually got into ETFs in 2001. Now, in 2003, kind of see that on the chart right there, that was the very first year that inflows into exchange-traded funds was greater than mutual funds. How about that? So 2003 is when that happened. Now, by the end of 2018, there were 100 distinct issuers of ETFs. There are all sorts of ETFs. The way I like to think of ETFs is kind of like when Apple produced the first smartphone, the iPhone, back in 2007. Remember 2008, 2009, that saying there's an app for that? That's sort of what's happening with ETFs. I get clients asking me all the time, Jeffrey, I want to invest in this area. I want to invest in that area. Is there an ETF? And chances are now, yeah, there's probably an ETF for that. You can't guarantee it. There's not always going to be an ETF for that, just like there's not always an app for that. I looked to see if there was a growing your money on a tree app. They haven't put it in the App Store yet. Not yet, but maybe one day. Maybe one day they'll have an ETF, growing your money on trees ETF. So let's talk about some of the benefits and risks of these things. Well, benefits are great. Transparency. You know exactly what they're invested in at any given moment. You also know exactly what their price is at any given moment. They are tax and cost efficient, and why that is because of the lower expense ratio. You can use them for diversification, which is wonderful. You can also use them for intraday trading. I love to do trading, not necessarily intraday trading, but I like using ETFs for that purpose because it takes out that single company risk. I still get a basket of securities and can participate in a sector, but I'm able to get in and out of it. And then, of course, as an options trader, they're frequently optionable, which is a lot of fun. Some of the risks, though, you got to keep this in mind. You can see fluctuations in returns, right? Liquidity can be a big risk. Liquidity comes because if you are in an